everyone. Anthony Scilipoti here, and today I'm joined by Nigel D'Souza, our financial services analyst and a member of our Veritas team. Today, we're going to talk about Veritas's performance and specifically our model portfolio, the V-List. Now, Veritas was started some 23 years ago with a vision to tell the truth. We turned capital markets on its head by getting paid from the users of the research, the investors, not by the companies that we write about. And what that's led to, that independent thought, has proven that when we make recommendations to buy or sell securities, that the recommendation tends to outperform. Over time, our buys have outperformed the index by about 375 basis points, and our sells have underperformed the benchmark by over 400 basis points. Now, that was particularly excellent during 2022. And it performs really well because interest rates are rising, and therefore costs of capital changes. So what you really saw, and we're going to give some examples of that when we look at individual stocks, is those companies that that don't have need for cash, that have a better balance sheet, and were generating earnings last year, perform better than those that didn't. And so you saw that our buys outperformed by over 400 basis points, and our sells underperformed the index by nearly 600 basis points. And that's played very nicely into our V-List.
Thank you, Anthony. So our V-List focuses on large cap, liquid, income paying, lower risk, and less volatile Canadian stocks. And as you can see from the track record of our V-List over the last 20 or so years, our V-List buys have outperformed the TSX benchmark by nearly 350 basis points. And when we looked at that performance over the long term, we can see that we have an exceptional track record of outperforming the TSX benchmark, both over the last year as well as over the last decade and since inception. That's driven by our focus on high quality, strong balance sheet companies that are fundamentally resilient and less exposed to both volatility or risk. When we think about our V-List in terms of sector allocation, in 2021, we reduced our allocation to the technology sector, and that was driven by concerns that the valuations in the technology space were not justified by the underlying fundamentals of the companies we covered. In 2022, due to concerns of rising interest rates and the impact rates will have on the broader economy and on market volatility, we increased our allocation to defensive sectors like utilities, staples, and commodities. We've also underweighted our exposure to financials in 2022 because financials are inherently cyclically sensitive stocks, with the exception of insurance companies, which we view as less cyclically sensitive and more stable in a recessionary environment. With that, I'll turn it over to Anthony to talk about some specific names.
Thanks, Nigel. And I'll add one more thing. Our V-List is concentrated. It's between 12 and 25 names. Turnover is very infrequent. And just giving you an example of how stock selection is very important. And and we're giving these examples because as we go forward, we believe interest rates are going to remain sticky, and that is higher than what people expect. And that's going to create an environment where stock selection becomes more important. So if you look at the rail sector, our analyst liked CP Rail and didn't like CN Rail. And so we added on September 2nd of 2021, we added CP to our list. And you can see that over time, it's outperformed both the index and CN by over 10 percentage points. And what's interesting there is his thesis revolved around the fact that CP is more of a commodity transporter than a consumer goods transporter like CN. When we look at what I think is one of the most sleepiest sectors, and that's utilities, even here we can find opportunity. And so in July 15th of 2019, we added Hydro One to our list. And this is also testament to how we hold on to things for considerably long periods of time. At the time, we could have chosen to put Fortis on, but we felt that Hydro One had a better balance sheet and had therefore better ability to both increase its dividend and take advantage of capital projects. And you can see from the performance, it's significantly outperformed both Fortis, and the index. And with that, we're going to look forward here. The market's going to remain choppy, and we believe that our stock selecting ability is going to continue to produce stable and powerful results. Thank you.
Thanks, everyone.